Welcome to Chit Chat Stocks. I'm one of your hosts, Ryan Henderson, and I am joined, as always, by Brett Schaefer. This is our weekly Power Hour episode, Investing Power Hour number 154. We're getting close to 3 years here of doing this. And on this show, we talk all things financial markets. We riff on any recent events. We talk about any earnings. We talk about the IPO market opening back up. We have a couple of high profile companies filing to go public. So we're going to rip through some of those, and we take any questions from the audience. We do these live on Wednesdays at 1:30 p.m. East Coast time, 10:30 Pacific time. So if you ever have any questions you want to ask us, feel free to head on over to YouTube and check it out. We also post these on the podcast player. So if you listen there, we appreciate that as well. But I guess let's get right into it a bit here. Brett, what are you excited to talk about today?
Yeah, this is usually the slow time of the week, or excuse me, the quarter. And luckily, we have a few IPOs that have filed to go public, Klarna and eToro. So we got to kind of scramble. We don't have earnings to talk about much anymore, but I do have Nike, which is at a bit of a crossroads as a company. And I think that, apologies, I think I'm a little loud there for the audience, but I turned myself down a bit. We have Nike that reported earnings. Another tough quarter for them. They're getting really, really beaten down in China. We have some more bubble watch from our friend Michael Saylor. Ryan's got a small cap of the week. And as a listener suggested topic, celebrating the tremendous outperformance of Berkshire Hathaway and Warren Buffett so far in 2025 and the last few years.
And collateralized burrito obligations. There's been plenty of memes made about this, but I think it's actually worth discussing because it's kind of interesting. And I'll be talking about that. It's a partnership that I'm guessing not a lot of people expected. So we're going to talk about that in a sec. But before we do, I want to talk about our friends at Public. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond accounts, 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA registered, SIPC insured, US-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks. Paid for by Public Investing. Full disclosures in the podcast description. Do we want to start with these collateralized burrito obligations?
Let's do it, Ryan. For anyone that doesn't know what the heck you're talking about, explain. Who is it? Klarna? One of these people
It is.
partnering? And what's the deal here? Why are they doing it? And then we'll discuss our thoughts.
Yeah, so for context, in 2008, during the GFC, and if you've watched The Big Short, the collateralized loan obligations, I think is what they were called initially. That was basically pools of mortgages that some of them were not so great, and that's kind of it created bad underwriting standards, and then it kind of ultimately led to the collapse. It was basically they were securitizing these loans. So the originator of the loans wasn't the one really taking the credit risk. They were passing them on to investors, that kind of thing. Well, this week, Klarna, which is I think one of the leading buy now, pay later providers, struck a deal with DoorDash. Now, Klarna, for anyone that doesn't know, buy now, pay later, it's basically short-term loans. And for the most part, these are 0% interest. So the way they make money is by offering buy now, pay later as an option at checkout. Apparently, it helps increase volume for a lot of merchants. So the merchants pay a fee back to Klarna instead of having the interest paid. So that's where the revenue comes from. But they also have interest-bearing loans as well. And then there's also late fees if you don't pay them. So now DoorDash customers can use Klarna to pay for their orders. So you can either pay in full, which I guess I don't know why you'd pay in full using Klarna instead of a credit card, provider.
Well,
Paying
I think
for,
it probably costs the same. Maybe there's points involved. Who knows?
yeah, maybe there's some sort of reward system, but there's so pay in full, pay in for, or pay later, which the pay in for, I think it's like basically you pay a quarter of it every 2 weeks.
What about pay never?
That is
No?
an option, and you get charged a late fee. I'm not sure what the collections process looks like after that, but so basically, yes, this is in some cases interest-free loans to people so that they can afford a meal. Now, historically, people have been using these more so for higher ticket purchases, things like a couch, a TV, something where it's quite expensive and it's just maybe you have a bit of a cash crunch. You'd rather pay it over 2 months instead of all up front. But yes, in this case, it's for a much lower ticket item. Now, if you're like me, you might think, would you really want to lend money to someone who can't afford a burrito? And that was kind of the question that was asked, but that is quite literally what they're doing in some instances. Now, maybe some of the DoorDash orders are multiple orders, that kind of thing. But if you're just buying one, you can use Klarna at qualifying locations to pay for your meal. Now, here's what's kind of interesting. Klarna engages in synthetic securitization of loans. Sometimes they, like I said, they charge interest on some depending on their credit score, meaning it sells these on to someone who is willing to take the credit risk. So they've got these credit partners, they securitize these burrito loans, and then you literally have analysts at investment firms saying, yeah, we'll take those loans. So people are
And the,
literally like betting on whether or not people are going to pay back their burrito loans in some instances. How hilarious would it be if this was the cause of GFC 2.0?
yeah, well, under $1 billion in loans, that's not going to be meaningful. But I do appreciate the candor. Yeah, I would imagine the meeting just like the beginning of The Big Short. And these burrito loans, gentlemen, they're AAA rated, and everyone starts laughing. They're like, "This is exactly what the Michigan Pension Fund needs." Yeah, it's interesting. I don't know if this is going to do much. I think maybe it spurs demand for DoorDash. DoorDash, it probably makes sense. They just want more demand for their platform. And we're going to get into the financials of Klarna here in a bit because they actually did just file their S1 for the IPO coming up. I'm assuming they made this announcement to bring some hype around the IPO. It's classic tactic from these companies. I still don't know why these need to exist or why there's any sort of competitive advantage here. They could argue there's an innovator's dilemma when going against the credit card companies like an American Express, JP Morgan, Bank of America, whoever's issuing out there. But a lot of these companies and a lot of the so-on quote-unquote credit card competition can copy this product. And I don't think credit underwriting changes just because it's pay in for, buy now, pay later concept versus credit card. This is something we went and talked about. There's really a debate for way too long during 2020 and 2021 on whether these were disrupting the credit card networks. I remember there was a fantastic buying opportunity with Visa because of a Chamath Palihapitiya tweet. So thank you for that, Chamath. Well, I didn't take advantage of it, but a lot of people did. Do you want to talk about the numbers here, Ryan? Because Klarna's growing pretty quickly, and they got a sizable business here. Although, shockingly, it's not profitable.
Yeah, like you said, I don't really understand the need for this business to exist, but it does. So we can rip into some of the numbers, but functionally, you might as well use a credit card. Like if you're a standard consumer, you want rewards, you're credit worthy. I don't see the advantage of using Klarna. If the idea is that you just defer your payments, you can do that with a credit card and you can earn points in the process. So anyway, it doesn't make sense to me, but people use it. So let's go through some of the numbers.
Yeah, they have an S1 here. They are a big mission-focused company. So we're going to skip that. People can read the narrative on that and how they're empowering financial freedom and all that good stuff. But if we look at their GMV, which is gross merchandise volume, and I'm assuming that's just all the dollars spent through its system, okay? Like someone similar to Visa. They have whatever it is spent through the network every year. Now, Klarna has $105 billion in GMV, $2.8 billion in revenue. They have 675,000 merchants using the platform, and revenue is growing 23.5% year over year in 2024. $121 million operating loss, but that is improving over the last few years. And the one thing I'll note, Ryan, and I'm not sure whether this is a figure that is supposed to impress me or disappoint me. They have 675,000 merchants on the platform. Visa, according to its fact sheet, has over 150 million merchants accepting Visa cards. It's quite a difference.
Yeah. I mean, I think a lot of these services are localized too. So Visa's merchant base is global. I would guess that a lot of people that are on Klarna also probably have some sort of a Visa or MasterCard branded card. But I would assume, because I think Afterpay was like pretty heavily focused in Australia. Klarna, I'm not sure where are they UK based?
Sorry, I was on mute there. I think they are Swedish, but probably more European focused.
Yeah, I mean, like I said, I still don't understand really the rationale for this. Maybe people just like the mental concept of paying things in installments, but financially it doesn't make too much sense. Yes, like I said, I would go with a Visa credit card or MasterCard backed credit card. It doesn't really make a difference to me. I think you're getting pretty broad acceptance just about anywhere. Same with Amex at this point as well. What do you think the valuation will be on this day one?
I have a little bit less confidence in this one compared to CoreWeave, where I think CoreWeave is going to, if they hit it right and they get the hype going, that could be an absolute blockbuster IPO, which means you should avoid it at all costs, but the number could get quite large compared to their actual revenue figures. So they're doing 2.8 billion in revenue. Operating loss $121 million. I'd assume the margins aren't sky high, but could be decent or long term. Maybe 20% operating margin, 25% maybe. I don't know.
Do they have any big cost of revenue?
I don't know if I can pull that up, but I'm assuming the credit losses are going to be there. Let's see. I think I have the S1 pulled up, but I'm not sure if it's on the right page. Oh yeah. Okay. Perfect. 2.8 billion in revenue in 2024. $596 million in processing and servicing costs, $495 million in consumer credit losses, $503 million in funding costs, $444 million in technology and product development, $328 million in sales and marketing, $203 million in customer service, $281 million in G&A. Well, you can see how they hit an operating loss. I think this doesn't go out. It shouldn't go out at more than a $10 billion valuation. I think it probably goes out 15 to 20, but this is not that good of a business. There are a lot of costs. You're in a hyper competitive industry, and there's no need for it to exist.
Yeah, I was going to give this $10 billion valuation on day one. Seems reasonable. Like, I obviously wouldn't be a buyer there, and IPOs are always a little bit extreme, but it seems like a pretty good possibility that it comes out above a $10 billion valuation. We've got some other IPOs, potential IPOs as well. Do you want to jump to that? eToro?
Yeah, we can. We had some questions here from your friend Aria. Says, touch on your morning routines. Are you doing the Saratoga water, whatever it is? Did you see this, Ryan? Some guy dunks his head in expensive water when he's getting up in the morning. No, you don't do this?
No, I didn't. I saw a bunch of memes about this. I'm not I don't actually.
Yeah, I didn't. I was a little confused myself. But what is your morning routine? A little coffee. I know you're a coffee guy. Just coffee and reading, right?
Well, I've shifted to time zones now, so I've got a little bit of time in the morning now. So I usually try to work out in the morning and then drink more
Oh,
coffee than I need.
wow.
Right
Start
around.
posting some TikToks. You're working out in the morning. All right.
I know. I've got quite the morning routine now. Yeah,
I'm more of the Bezos mindset, which is,
still
it's an
mornings.
advantage to be a little lazy in the morning. Yeah. I just get up and kind of, am cloudy for about an hour.
Yeah, I'd say
Let's see some.
weekends. That's probably more what my weekends look like. But
Let's see. Someone's asked, what do you think happens to buy now, pay later if the paper market closes, such as during the GFC? Yeah, reminds me of the big concerns at Upstart that almost materialized and have been a big risk for them, where they're trying to underwrite some loans and then offset it to third parties. Well, if that process closes, you have a bunch in your balance sheet. You better have the capital to absorb that. And these companies are not nearly well capitalized as an American Express, a JP Morgan Chase, or a Bank of America to absorb all these loans. So, yeah, I mean, it could be a huge issue.
yeah, a lot of people, when Upstart was going kind of crazy around 2021, 2022, and for anyone that doesn't know the company Upstart, it was basically AI consumer lending. AI in quotes, but basically it was just a consumer lending algorithm that was meant to sort of emulate the FICO. Like they were trying to say the FICO was outdated and that they had a sort of a new formula for determining credit worthiness.
Yeah.
Anyway,
Proven on the FICO.
They were doing the same thing. They were selling on these loans to third party credit or partners and basically investors. And everyone said, well, it's asset light. They're not taking the credit risk, but it's really easy for those investors to say, we're pulling back on our, on what we're buying here. We're not interested in any more loans. And all of a sudden Upstart either has to start hamping down what it's willing to take, what kind of loans it's willing to write. Same with like Klarna. In this case, I imagine all the buy now, pay later providers are doing securitizations. So they'll either have to decrease volume or they'll have to take the credit risk themselves. So there is, while it's not directly credit risk, there is credit risk in sort of a macroeconomic, in tougher conditions.
Yep. Do you want to guess Upstart's market capitalization right now, as of this recording?
I think they've had a bit of a revival, if I remember correctly. Let's go $2 billion market cap.
$5 billion, Ryan. Yeah, the stock price ticked 400 in 2021. It was a 10-bagger in a year. I remember telling everyone to sell because a 10-bagger in a year means you should sell, and they didn't listen to me. Stock fell to $15, or maybe even lower. I'm trying to just kind of, a little bit below in late 2022, $13. Today, we're back up to 53. A little bit of a recovery, so maybe they're on the upswing.
Yeah, what is easier? Like, that's a perfect example of fast-growing financials. Fast growth is not always a good thing, especially for financials. And I mean, they were able to pass it. The hardest part of that business, I imagine, is finding credit partners. And so once you've kind of found the credit partners, if they're willing to expand volume with you, I mean, then you can write whatever loans you want. I mean, you can grow as fast as you want in that case, but eventually those credit partners are going to stop buying from you. So, yeah, fast growing financials, always be a little wary, especially try to get an understanding of who's taking the risk. Let's talk eToro. Actually,
Okay.
there was another question that I'll pass along to you in a second, but eToro filed to go public. They are a trading and investing platform headquartered in Israel, and it allows people to follow the trades of other accounts. So, sort of like a hybrid social plus investing app. It's actually pretty popular. I imagine some of our listeners may even be on the platform, and it reports total follower assets under copy as sort of like, how you see follower count on Twitter or X or whatever. This is like the amount of assets that are copying you. So it's kind of just meant to determine like how popular you are as an investor, I guess. And initially, I think this model was pretty unique, although there have been a lot of platforms that tried to copy it as of late. And the growth of the business actually looks pretty good from the numbers they provide. They have 3.5 million total funded accounts, which is up from 2.6 million 2 years ago. So solid growth. first of all, does that number surprise you at all? 3.5 million funded accounts.
I guess not, because we're in such a bull market and we've seen Robinhood, IBKR, all the ones that are publicly listed have solid growth. And in a bull market, you're going to see more accounts getting activated.
Yeah, I guess maybe you can pull up what Robinhood's funded accounts are, because I'm curious in kind of.
Yeah, it might be 10x that. Yeah.
I think
I'll
it's
pull it up.
around, I thought it was around 15 million, somewhere around there, but could be wrong.
Yep. Is that a KPI on our friends at FinChat?
Yes,
Probably.
they should have
Okay.
it.
I'll pull that up.
Anyway, so looked like a relatively decent business. However, the income statement was a nightmare to dissect because of all the crypto trading involved in this business. It makes it so and not only crypto trading, but like crypto trading with derivatives too, makes it super complicated to understand. If you're just looking at it on like its pure income statement, like that image that they've got of the income statement, the standard gap one, that part kind of sucked to read through. But it's kind of like that block or square thing that they had where it was crypto trading. And so like you have
didn't know how to count for it. Yeah.
Yeah, it's crypto revenue, but basically it gets overstated because in this case, eToro buys it and then sells it. So
it's like a GMV. So you got to net that out.
Yeah, it's
they're not going to make any money.
Trading volume.
Yeah.
And basically, they end up breaking down their overall contribution profit, which is quite helpful. And so in 2024, a quarter of their business came from trading on crypto assets. 42% came from trading on equities, commodities, and currencies. I kind of like that better. It's nice that the bulk of their business is from that. 23% is net interest contribution. The 9% is eToro money, and then the rest is subscriptions and others. I think they've got like eToro Gold or something like that. Anyway, they've done $787 million in contribution profit over the last 12 months, which I guess you could kind of think of as net revenue.
Well, maybe more gross profit, right?
Yeah.
I'm looking at the income down here. That'd be pretty good margin.
Just interest expenses deducting from their interest income. So,
okay.
It's kind of like a net revenue, but yeah. Anyway, gross profit, net revenue, it's kind of similar in this case. They are generating some solid income before taxes of $246 million. However, nearly 200 million of that is net interest income from users. So that's obviously interest rate sensitive. That doesn't mean it's going to disappear next year. It's depends where interest rates go in general. But I thought that was actually pretty solid overall. There is kind of this very heavy crypto bend, and a lot of the growth has come from increasing volume in crypto trading. What valuation do you think this comes out at? We're talking about pretty solid operating margins if you use contribution profit as the numerator here, but 250 million roughly in EBIT,
earnings. Yeah.
Growing at a nice healthy pace in terms of funded accounts. What do you think?
Well, I think it should be probably about 5, given the pro-cyclicality of this industry, but I'd guess closer to 10. I don't like these businesses whatsoever because of how pro-cyclical they are with bull and bear markets. Maybe for a high-quality run one like an IBKR, I'd be looking to buy during a bear market or when there's an anticipation of trading volumes collapsing, and you can kind of time it like a cyclical, which I should say, that is the next company I'm going to be researching for Chit Chat stocks. But I don't really have much interest here. Ryan, do you think 5 billion to 10 billion makes sense? Seems like a fine business, decent company. It's not the leader in the industry, although I thought Robinhood was much bigger from a user perspective. Their monthly active users, the December 2024 figure was 14.9 million, actually lower than 2021, 17.3 million.
I will give credit to Robinhood here. The average account value is like double what it was in 2021. So
okay,
I think they've gotten rid of some of the lower quality customers potentially. And by
they probably got rid of
quality, I just mean less money in their accounts.
Yeah.
They maybe did that to themselves there. Yeah, I think it's a fine business. In general, I'm seeing a lot of. It feels like we're seeing Israel sort of produce some fascinating tech businesses.
Oh yeah,
Monday.com, Wix,
Wix. Yes, sir.
eToro. I'm trying to think. There's some other big ones as well, but I'll leave it there for now. Yeah, there is. I don't know. It's kind of
Yeah,
producing some unicorns, as they say.
yeah. They got to get VC market and yeah, software, financial technology, and defense tech. Those seem to be the big three. Yeah. All right.
Let's. I want to talk about Nike.
You want to talk Nike first? Yeah, I was gonna say Nike or Bubble Watch.
I can't hear the word Michael Saylor again if that's what you're going to mention. So we got
Well, this one is
Wiz too. Someone just mentioned Wiz in the chat.
Wiz. Yeah,
Just got bought for $30 billion.
true.
32.
Cybersecurity. Oh, duh. Cybersecurity. That's kind of, I guess, defense tech a little bit, but yeah, cybersecurity for sure. All right, Nike. You want to do Nike, not Michael Saylor, my guy, Michael Saylor.
Please, no? Nike.
Your drunk uncle that you met at Future Proof.
Yeah, let's go with Nike.
Okay, so the headline I put here is Nike now a maybe we try to not swear on this because the kids might be in the car listening. Is it a bad company? Is it the blank co that we like to describe bad companies? The stock is now in a 60% drawdown. Revenue fell 9% year over year last quarter. Last 12-month operating margin of just 10.5%, according to our friends at FinChat, which when you chart using margins like that, that's one of the best ways to visualize how a company is doing and how for example, we've used this for Tesla time and time again when they went through that period of pricing power versus they've had to lower prices. Nike's had the same thing where they've had inventory gluts, they've had to decrease prices, and that operating margin has fallen flat. It's a great way to visualize that. And you can go back 10, 15 years and even longer if you sometimes using the charting tool. So yeah, shout out to our friends at FinChat. Use our link, finchat.io/chitchat. Get 15% off any paid plan. More numbers here. China revenue is lower than in 2019. They are struggling really badly in this market. And then the last figure I'll have here, EV to EBIT is now 20 on what, if you're an optimist for Nike, would be potentially trough earnings. Are you interested, Ryan? Or is this another notch in my belt for never invest in apparel?
I think this is another notch in the belt, honestly. Now, I think at one point, maybe over the last 2-3 years prior to this drawdown, there was kind of the sense that Nike was sort of bulletproof. Although if you read our friend Alex Morse's write-ups on the company, they were missing estimates constantly from like they were not growing very quickly and they were missing their estimates, and then they would once again put these really optimistic estimates out there and they wouldn't be able to achieve them. So that kind of happened again, and now we're seeing just sort of a sheer collapse, especially in the footwear business and particularly in China as well. Plus some competitive threats also. The Alex shared a chart recently that was pretty good, and it basically showed there's apparently two competitors in China. I think it's like Anta something and
local competitors that you don't see the brands over here, right?
Correct. So if you combine those two, you combine Hoka and you combine On Running. So all of those four, I think it was 2 years ago that accounted for 25% of Nike's footwear revenue. Today it accounts for 50% of Nike's footwear revenue. I'm going to share a chart here as well. This is Hoka and On Running's growth versus Nike's footwear business.
And that's another one from our friends at FinChat. Yeah, look at that. Dang. What is it?
Nike's footwear revenue has, since Q2 of 2021, so basically over the last 4 years, it has grown 9% in total.
Cumulative.
While On Running has quadrupled its business and Hoka has tripled its business. So
Hoka plus, or that's Hoka specifically. Oh,
that's okay. Just Hoka.
Nice. You can really.
Yeah.
I'm just a walking advertisement for the platform. You can segmentize that. That is nice. That's a nice looking chart.
So I don't know. every time I read about Nike, I think, obviously tons of brand value. That's great. But I don't love investing purely in brands. And you look like it's just a tough business. There's always inventory issues. Consumer preferences change, which makes your inventory depreciate quicker than you think it's going to.
Easy to make a competitor now.
I don't like apparel. I just think it's such a tough business.
You're joining the team. Huh? This, I think, question from Tyler in the chat here relates a lot to the sentiment you have right there. Do you guys think the internet has permanently broken brand power? It just seems like it is easier than ever to scale a clothing, shoe, energy drink, or CPG product due to the internet. Seems like Lululemon, Nike, Celsius, and Coke have all lost their moats, which existed due to the scale advertising on TV. Celsius and Lululemon might be a bit new for that, but I agree with this sentiment. If you are a brand, you need something else for a competitive advantage, I believe, in order to maintain that durability, give yourself a wiggle room to have a longer term mindset. 3 examples come to mind for me that have had more durable brand power in the age of the internet. One is kind of an internet company, Apple, right? They have multiple competitive advantages besides their brand. Second, American Express with the network effect and scale there. And third, Nintendo with a vertically integrated software platform, or software hardware platform, excuse me. Does that make sense to you, Ryan? Is that kind of I think, a good way to put brands versus brands you'd maybe invested versus brands that have zero competitive advantage in the age of the internet, where large scaled advertising on TV, it's just not going to build you a moat anymore. Where Nike, yeah, they're one of the best makers of commercials ever. They partner with athletes. The Jordan brand was obviously one of the best moves in the maybe ever in the shoe industry. But you are still fighting tooth and nail every year at this point.
Yeah, I think you're right. So I think you need something to your moat beyond brand and storytelling, and it's the same issue with Disney now. There's other issues as well, but like
Disney's a great chance versus Nintendo, where they have that other competitive advantage.
Right. You need something else, and for apparel, I don't know how you create that other element. Maybe having really successful omni-channel presence is important, but that's not
some sort of store thing.
That's also like potentially baggage if things turn the other way. So
yeah, maybe only the luxury companies are okay.
Let me run.
But even LVMH is struggling.
Quick question for you. Who do you think has better returns over the last 5 years, Nike or Skechers?
Total return?
Yes.
Well, Skechers. Kind of a leading question.
Can you guess Skechers' total return?
Ooh, well, we had. Why am I blanking on his name? Good investor, the guy
Ben Claremont.
Yeah, lives close to, I think, the Skechers headquarters. 5 years, 200%,
112%. They're kind
pretty
of
good though.
Recent drawdown. So, and I'm not sure what for them. I just think there's risk as a premium brand. If you're considered a low-cost provider, that is an advantage. If you can truly be a low-cost provider, that's great. And I think Skechers kind of fits in there. Generally, with a lot of their shoes, I think you could probably call them a low-cost provider, not the ultimate low-cost, but there's some brand notoriety plus being a low-cost. Nike, obviously, just different ballpark, different game in general. Maybe this is just economic cycle talking, and maybe in 5 years we're going to be saying like, you got to be the premium brand in these industries.
Maybe,
but I just think apparel in general, I'm never going to touch it.
Yeah, it doesn't make sense. Play an easier game.
The big difference, I'd say, with touching on the comment here, Celsius, Coca-Cola, they are literally addictive. I think that's a bit more helpful than And maybe you could say shopping at Lululemon is addictive for some people, but I think with Celsius, you're getting that caffeine, which helps.
Yeah,
Kind of
CPG food products are a little more enticing for me.
a little more customer loyalty, I'd
Yeah.
say. So
I still think you can have that, although I do get the point where I like to do a check with Celsius. I haven't owned the stock. I've said I like it. It's climbing up the watch list, but unfortunately, I said I liked it at 22, and now it's at 34, and I haven't done anything. But when you search, I like to search on Amazon just energy drinks. That doesn't seem like Celsius has a moat in that regard. Distribution is not a moat whatsoever. Amazon has a lot of power there.
yeah, we've got a comment here that says Nike used to have the distribution moat, but they killed that themselves. Yeah, I mean, you see it in the commentary from management today, straying away from their wholesale partners. And I mean, 3 years ago, they really hurt a lot of their wholesale partners. I mean, they like really started to prioritize their direct to consumer channels. And
So that angered them, like Foot Locker, stuff like that.
well, I mean, it hurt the businesses from just like financially. They stopped feeding them, I believe, a lot of the items. So yeah, I'm sure.
I'm sure, and then they switched to competitors, I'm guessing.
Yeah, that they're saying that they're trying to kind of focus on those partnerships again, but I just think going DTC here, I don't know if that's not giving you any sort of competitive advantage. I think being everywhere is a bigger advantage than having just a great website.
Yeah. You know what this reminds me of? Allbirds. Remember when we used to have Brad Freeman from the Stock Market Nerd on? You guys were hyping up Allbirds. You love the product. Doesn't matter.
Never owned shares. And hey, yes, apparel. It's apparel, and it's a fickle business. Just plain and simple.
All right. We're going to talk other topics here. We have Bubble Watch, Small Cap of the Week, and Boeing's new contract. But Ryan, you want to talk about some of our sponsors as we get halfway through this episode?
First one here, Blue Chippers Club. It is 100% free. It's a tight-knit community of stock-focused investors started by two friends of ours, and they have weekly meetings. You can throw your portfolios in the chat. You can pitch stocks. You can receive great, useful feedback. We've talked about it here on the show plenty of times, but truly, I have found myself getting a lot more value out of a focused community like that over just general social media. So I recommend checking it out. You can build a true network of like-minded investors. It's totally free. BlueChippersClub.com. Head on over there, hit apply. We're going to have the link in the show notes. And then once again, Public. If you are serious about investing, you need to know about public.com. That is where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered, SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks. Paid for by Public Investing. Full disclosures in the podcast description. Brett, what do you want to talk about next?
What about our friends at Boeing? This is a short one. Winning the NJAD contract. Did you know what NJAD was, Ryan?
No.
All right. So Boeing, in a surprise win, won the $50 billion plus maybe more of the long-term contract for the next generation air dominance platform. That's a good name, right? That means that says this is an important plane here. It's NJAD, NJAD for the acronym, and it's for the U.S. government, the next generation fighter contract for the U.S. government. My question here is, what bribery occurred to get this over Lockheed Martin or anyone else? Here's a quote from the Wall Street Journal that I think sums up the surprise here. Quote, the U.S. is entrusting its most expensive fighter jet program in history to a company that hasn't successfully launched a commercial or military aircraft in a decade. I don't think ever has launched a successful military aircraft, to be honest. The way I compared it, at least I thought about it, is Lockheed Martin just developed a plane that defeated the sonic boom. I don't know if you ever saw that. And Boeing can barely make its own 737s that it's made for decades. I
Yeah,
don't get this. I don't get this one.
the commercial and government are like two different businesses, so it's not the biggest deal that the 737 production issues. Like that's not going to impact. I don't think it would impact. Maybe it diverts resources and focus from some people, but two separate divisions. But yes, it seems like Lockheed Martin was kind of a shoo-in for this. My gut tells me there's some politics involved here.
Yeah, maybe, or someone doesn't like Lockheed. Yeah, I don't get this one. We'll see what happens, but I don't really have much to say except that Lockheed, I guess, could be the stock fell. Could be a buying opportunity. I don't know.
Maybe Boeing just needed this and the government knew they needed this.
What's weird is that the government should be upset with them. One, because of the obvious issues with the commercial side of things, but they've delayed. They can't even make a single Air Force One. They're supposed to make the new Air Force One, and they keep delaying it. It's like, is it? I don't know. If you give this contract, the NJAD contract to Boeing, I don't think it ever gets made, honestly, at scale.
Yeah, I mean, we talked about this, I think, like 5 episodes in a row when there was the unionization, the
Right.
strike going on at Boeing. But this stock makes, of all the horrible stocks out there, and I guess it's kind of unfair to lump Boeing in with some of the like very, how should we say? I don't want to swear, the bad companies that have great stocks for some reason. It's bad to lump them in there, but this stock makes no sense to me.
Yeah.
It's priced like it's already recovered and production is already back up. Like, I don't know if it's just held by so many institutions that'll never sell or what, but it's trading at a pretty extreme multiple. Like, it's trading at a reasonable multiple if the business were operating well. It's not operating well, and now they're going to have to pay their factory workers significantly more. So the economics are already going to look rougher coming out of this, assuming that production gets back to what they were at without a hitch, which seems like a very tough problem to solve. So I don't know. I don't understand Boeing at all, to be honest.
Yeah, apparently this contract is cost plus, so they're guaranteed to make a profit. But I still like Lockheed over Boeing.
Yeah.
Pays a nice dividend, repurchaser of shares, steadier contracts, better history of profitability. None of this union nonsense that they got to go through. Not that the workers don't deserve a lot, to get paid, but I'm just saying from an investor perspective. Yeah. I don't like it.
I don't see myself owning either, to be honest.
Yeah, Lockheed's for someone that's 60 years old. Yeah, exactly. It's the perfect retiree stock, not for people in their 20s.
It's the perfect stock for someone that's worked at Lockheed for 5 decades.
Yeah, exactly. Although, Ryan,
good
total return last 40 years, I think it's a 100-bagger. Really? Even without dividends. I'm just going, with dividends, 100-bagger.
Solid. What's your bubble watch? Let's get to it. Michael Saylor, go ahead, say the name. What do you do?
Well, there's this video. I want to figure out how to share a video and play it, but we're not going to test that here. I keep wanting to try to do that. We're going to test it in the live stream. But essentially, there was this video from a podcast interview of Michael Saylor, and so there's this thing called, you have your keys in Bitcoin. You have to have the key to access the cryptocurrency. And if you don't have the keys, well, then you have no way to access it. And essentially it's lost. It's not tradable. It's not sellable. It's not convertible. And in a podcast, which Michael Saylor seems to go on every day, he says he confirms, well, this is a tweet and it was a very confusing video. So let's not confirm or deny anything, but it says here that he's, quote, burning the keys to over 17,000 Bitcoin worth $1.5 billion. And that's my legacy, quote unquote. And the reason, Ryan, think about how Ponzi scheme-ish this is. I'm going to restrict the supply so much so the rest of it goes up. I'm just going to get rid of it all. And using this logic, Ryan, should we just get rid of all the Bitcoin so there's only one left or none left, and then we can just all say it's magically worth whatever? How? I don't know. The brain can't even comprehend what's going on here.
This is actually brilliant marketing, if that's his goal, which is he can say this and just go ahead and not do it. And if people think, wow, he's going to really restrict the supply for us because that's how much he cares, it's like a faux donation that really just only benefits him.
It's not a donation though. It's so hard to comprehend.
To the crypto community.
It's saying that we're going to make this worth nothing,
so that everything else can be worth more, Brett.
But why?
That's the implication here.
The implication, the logic I take away from this is that all of it is worth nothing. But whatever. The way you have to go through these logical leaps in your mind to just wiggle your way through to say, oh no, this is great for Bitcoin. I'm not saying you, but people in general. I mean, just take a step back and think about what is going on here. It's just magic means. It's crazy. Do you want to hear about their new preferred stock, Ryan? Because we have more strategy news.
I don't know if I do, because he's got my brain in a pretzel already.
Okay, this one's a little bit more understandable because that one's a lot of just kind of Matthew McConaughey in Wolf of Wall Street type stuff. Now, apparently, Strategy, which is MicroStrategy's new name, has added a new financial instrument to get exposure to its business. And it is called, not a typo here, Ryan, I'm saying this correctly, a perpetual strife preferred stock. Weird name, but let's go through what it is. It offers a 10% dividend yield that grows if the payments are deferred. However, and I thought this was quite funny, the Financial Times had some great reporting on this. They can stop paying this dividend whenever they want to, with no reason needed. Now, how do you think they expect to pay for these dividends, Ryan? Profits, right, from the business? Cash flow? No. Quote, we expect to fund any dividends paid in cash on the perpetual strife preferred stock primarily through additional capital raising activities, including, but not limited to, at the market offerings of our Class A common stock and our perpetual strike preferred stock. This is the exact definition of a Ponzi scheme, and they are literally saying they're setting this up. A Ponzi scheme.
This is fantastic. You know what? You can consolidate the entire MicroStrategy thesis into one thing. Bitcoin has a finite supply. MicroStrategy shares outstanding has an infinite supply. And they intend to make money in that transaction. That by just infinitely selling shares, marketing, and buying Bitcoin. Yeah, this makes no sense to me from like who would be buying the preferred stock? Like, I don't understand why there's a buyer there when you've got a.
Well, people bought BlockFi. Same thing.
Yeah, but in this case, well, those were sort of fake promises. This is like just coming outright and telling you that we might not pay the dividend if we choose not to. So
yeah, I guess. Well, BlockFi had, I bet, had the exact same thing.
Yeah. Do you want to
so you're not going to be buying
a real business?
Yeah, you're not going to be buying these new preferred stocks or strifes?
No. And you know what? My goal for the next month is to not hear or say the word Michael Saylor.
I enjoy how you had to hear him live. But yes, let's look at a real business, small cap of the week, and related to the last week's one from a listener's suggestion.
Yes. Last week we spoke about Herc Holdings. They are the third largest equipment rental company in the United States. In that episode, I mentioned that the only other two equipment rental companies that are larger are United Rentals and Ashtead Group, which operates Sunbelt. So if you live in the U.S., you've probably seen Sunbelt equipment somewhere, either in a Sunbelt facility or on a construction yards. You know, they're all over the place. Well, this is what a listener sent to us. He wrote us a message. Sorry if I didn't get the name, but if you like Herc, look at the specialty spinoff of Ashtead Group, or look at what the specialty spinoff of Ashtead Group did with Ashtead Technology. Way more growth potential with the aggressive roll-up strategy, paying low single-digit EBITDA multiples and trades at a lower valuation than Herc. Well, I took a look at it, And so far, I like what I see. $591 million market cap. So certainly qualifies as a small cap. They also, I found a few interesting write-ups, so I'm going to quote some of them here. Ashtead Technology is a rental equipment company in the offshore wind and oil/natural gas space that was founded in 1985. It's a similar model to Ashtead and United Rentals generally. They're renting specialized equipment to companies that service offshore wind, oil, and natural gas installations. First of all, equipment rental business, I kind of like it just overall. I talked about this last week. There's some economies of scale to the bigger players because you can service global customers and there's less, delivery time needed. You can offer multiple services, multiple equipment to the same. There's just a lot of benefits to being the scaled player, which Ashtead Technology is. Little bit of corporate history. They were founded in 1985, like I mentioned, acquired in 1993 by Ashtead Group, and then sold to private equity in 2008, and then IPO'd in 2021. So they've been in the public markets for a little over 3 years.
They've been a good customer for lawyers and investment banks, huh?
Probably, yeah. 30% of revenue is from offshore wind, 70% is from oil and gas, and importantly, most of their equipment is fungible, meaning that it can be used for both industries, which kind of insulates them a bit from acyclicality. So
Offshore wind, yeah, the bubble. There was, I think, a bit of a bubble in wind, and that's a weird thing to say. Wind energy, windmills, the energy generation windmills. There's a bit of a bubble and it popped. And looking at their financials, I would have thought they would have seen a downturn in that, and looks like they didn't.
Yeah, and there's been a lot of, one of these write-ups went into great depth on the offshore wind industry overall, and he made a compelling case that while it's not the most cost effective to implement, because there's really no way to take out the cost of having to go out on a boat and do this in the water as opposed to just putting a windmill on land. There's certain cases where it's the right fit for certain geographies. He called out Japan as an example where, you might not have all that much space to have onshore windmills, but you've got tons of water around you, or there might be sort of the NIMBY, not in my backyard, don't want the windmills there, that kind of thing. Sometimes transmission lines are so costly to get out to those spaces that it just makes more sense to go and put these in the water. Ultimately, he made the case that some jurisdictions, some areas just prefer offshore, which made sense to me. But yeah, 70% is from oil and gas. The remainder is from offshore, and they kind of play off one another, right? Where it's kind of unlikely you get huge investment downturns in both. But ultimately,
I would say if we were smart and just went into nuclear energy, which makes more sense compared to either, then yes. But I don't think that's the world that's going to happen in the next 10 years.
Yeah, seems unlikely, but I guess who knows there. Ultimately, they are somewhat insulated from the cyclicality, and then some of the geographies might say, oh no, we're done with offshore wind or whatever. They'll still need oil and gas, or obviously vice versa. The customer backlogs look really good. So a lot of the producers here are planning to invest a ton more into these different energy sources, which that's kind of one of the most important KPIs or things to track for Ashtead Group, because they are going to be servicing all of these projects, both on new construction as well as maintenance. So a good chunk comes from just maintaining the existing projects. If you look at revenue and operating income, $210 million in revenue over the last 12 months, $55 million in operating income. That's grown at a 27% annual rate over the last, call it 5 years. That's the revenue. Operating income's grown pretty similarly. Margins are kind of steadily above 20%. Today's EV to EBIT is 13 times. I really like this. It doesn't feel, my concern when I started reading about this is that it's going to feel a bit like too much like a commodity play, too much energy focus, but it seems like they are somewhat removed like from the commodity prices and such. So I think this could be sort of a real long-term winner. I like the characteristics of the equipment rental business generally. It's a little more specialized and they have huge deals with all the global customers. Um, and they can service them all around the world, which is really nice. So I appreciate whoever recommended this one to us. I will be this will be added to the watch list for me.
Yeah, it does seem interesting. I saw Subsea 7 on there from our old episode with Bob Robati that I think people enjoyed. Yeah, it's a good industry. It's one that's going to be around for a while. It seems like it's not one that's going to have a lot of competition coming to market. Solid business. I hope it could get at a little cheaper multiple. Do you know what the cash flow conversion is?
No, I don't. But they do a lot of like those little bolt-on acquisitions, so it's a little distorted anyways. I in this write-up that I read, they said the cash flow conversion is pretty good when you strip out the expenses that they're paying for these acquisitions. So I'm not totally sure, but I'll look at it.
Yeah, pretty interesting. All right, we got 5 minutes, Ryan. Do we want to celebrate a little-known investor named Warren Buffett and Berkshire Hathaway? We had a listener suggest this one. He said, maybe you should talk and do a tip of the cap to Berkshire Hathaway having a 3-bagger over the last 5 years, even though their cash position is at all-time highs. Have you seen the performance of Berkshire, Ryan? Maybe we should add a chart comparing these. But
it has outperformed the S&P 500 on a 5-year, 10-year, and 15-year
nice
time horizons, which I don't know. That's just so nice to see because so many
well, he needs that win. Yeah, I mean, the guy's, he needs the help.
He's really struggled. Now, it's nice to see because so many people, you see this rhetoric all the time of, well, he missed out on owning like all the best
Google,
businesses.
yeah.
And he's outperformed them for the most part, if you consider the market basically big tech, which it kind of is.
Yeah, let's see. 5-year total return. And this is pretty much, we're at the 5-year anniversary of those COVID lows, Ryan. You remember that? The panic?
Yes.
10% down days. General Ackman on TV yelling. Berkshire Hathaway, total return. They don't pay a dividend, but we're using that to compare to the S&P 500. 189% over the last 5 years. S&P 500, 137%. And there's been quite the diversion in 2025.
It's funny. Well, it's kind of funny because right now the cash balance might be what's helping the stock because people appreciate the safety of him just collecting interest on these treasuries
and taking advantage of the downturn.
Yeah, and being able to potentially take advantage. There is no everyone keeps quoting the nominal cash balance that he has, which I think is like 350 billion or something like that. I hope I'm not way off with that number, but it is also 29% of total assets. That's the highest cash allocation he's ever had, as far as I know, as far as the data goes back. Maybe in the early Berkshire days, there might have been a different situation, but it's a real statement. And for anyone that says, oh, no, this isn't timing, I think to some degree it really is. He also sold assets to accumulate this cash balance, right? Bank of America, Apple. So, yeah, it feels like a real statement. And the fact that he has been able to outperform while having now the cash it jumped a lot in the last 2 quarters. So some of the outperformance has come prior to having such an exorbitant amount of cash. But yes, I think it just goes to show how impressive a lot of the operating businesses are, and B, as much as he isn't necessarily he isn't broadcasting that he's timing the market, he does have kind of impeccable timing.
Yeah, and he's not timing the market. He's just doesn't see anything he wants to buy, so he's just taking a risk-reward analysis of that versus treasuries. I think now, like you can see in 2025, the diversion versus Berkshire and the S&P 500. I believe in the short run right here, this is just a flight to safety. Not that it takes away from the long-term performance, but I'm sure there's a lot of short-term people, short-term traders. I know Ackman said this before, that they use Berkshire as almost a safe haven, which Buffett hates. He hates when people do that, but I think that's what's going on here. The last thing I'll say before we end this live stream, the price of Berkshire Hathaway A shares, $798,000, well, and $13. Say roughly $800,000, Ryan. Do you think Buffett, one of Buffett's not selfish and more of just the investing game, his long-term goal is to get that to $1 million before he dies?
I'm sure it'd be a nice round number to have. Yeah.
Yeah, he hits it kind of like the Cubs fan when they won the World Series that dies immediately after they win. But that would be a cool number. It's an awesome milestone.
It would be cool. I do think there were a lot of implications in this year's letter that he might be stepping down sooner than people think. Like maybe it's just like 5-year, 10-year thing, which obviously is a long time given his age. But he mentioned that Todd Combs is going to start writing a lot of these letters. I think at the beginning he mentioned that he's using his cane. It felt like there were a lot of references to his age where it was kind of like,
yeah,
an actual like, get ready, this might not be me anymore.
Yeah. I mean, look, what is he, 94? He can go at any time. Like, not to try to say it bluntly, but it's the truth. All right. Well, that's a happy way to end it.
let's end on a better note. Would you sell if you had been a long-term Berkshire holder and Buffett's no longer in the company and it's just Todd, Ajit, Ted, and am I missing any?
Weschler.
Yeah. Are you comfortable with them as the managers?
I like 3 of 4 there. I don't know much of Combs. I don't know. Not my favorite.
He lacks some charisma, but he might be a great
Well,
operator.
Yeah, he also
right.
Geico isn't doing too hot. He's apparently doing that while running a giant investment portfolio. I just don't. He's not my favorite, but I do think obviously the culture there is strong and Abel.
I'm getting him confused with Greg.
Oh yeah.
Greg,
no, Abel's good.
Yeah,
Ajit's obviously great. They're all getting old though. I don't know. It's a big company. I'd probably sell if he passed.
I would guess most shareholders are kind of just in there at this point for
forever
reasons beyond the in potential returns.
Yeah, exactly. And what I would enjoy is a nice little tax-free special dividend if I was someone that's a long-term shareholder. Get smaller to get bigger.
Yeah, that can make sense. All right, I think that's going to do it, huh?
Let's do it. Yeah, let's close things out here. Thank you to everyone who joined the live stream. I know only a few people do it, but really appreciate it. Asking the questions, always good time. You can do these or join along with the live stream on Wednesdays, 1:30 p.m. Eastern time, or you can watch the replays on YouTube, listen or watch to the replays on Spotify, Apple Podcasts, wherever you get your podcasts. We don't care how you listen, just that we appreciate that you do listen. Now let's hit the disclosure before we close things out. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in once again, and we'll see you next week.